Behavioral research by Dalbar shows that the average investor dramatically underperforms the market over 20 years. Not because of bad luck, because of pure, unadulterated human overconfidence. We think we are the exception to the rule. Meet Deepak and Kavya, two regular people who started their investing journey on the exact same day with the exact same 2 lakh rupees. 3 years later, Deepak's portfolio hit absolute zero, while Kavya built a compounding wealth machine. How did two smart people get such violently different results? I'm Ray, and today we are breaking down the exact psychological traps that destroy portfolios and the boring blueprint that saves them. Because if you don't know the rules of the game, the market will gladly charge you tuition. Let's dive in. Welcome to the deep dive. I'm Ray, and I'm thrilled to have you here today. Whether you're stuck in Bangalore traffic, ignoring a mountain of emails, or just walking your dog, you are in exactly the right place. Today, we are talking about wealth, but not the buy a course and get rich kind. We are dissecting the actual mechanics of money. Actually, it's more about the psychological and mathematical traps that wipe out even the most well intentioned investors. Our mission? Finding the ultimate shortcut to building wealth without getting wrecked by the market. No pressure, right? I've synthesized a mountain of data for this. Forbes, Bankrate, behavioral research, the works. We are even looking at real world market news, real companies, real money, real heartbreaks. Because let's be real, we live in the era of FOMO, fear of missing out. It's a literal plague on our wallets. You open your phone and boom, the algorithm serves you a finfluencer flexing their overnight crypto gains or some next big stock. It creates this illusion that everyone is getting rich effortlessly, while you're just sitting there missing the boat. But the chasm between that perception and mathematical reality, that's where most people lose their hard earned capital. So, to bridge that gap using data instead of emotion, I want to follow a financial showdown between two Gen Z investors. Meet Deepak and Kavya. They both entered the market on the exact same day with the exact same amount, 2 lakh rupees. Fast forward 3 years, one of them had a portfolio worth zero, the other, a compounding wealth machine. Their paths are a perfect laboratory for us. Let's unpack Deepak's strategy, or what I call the social media trap. Deepak is a smart guy, don't get me wrong, but he wanted a massive multiplier. He wanted to beat the market. He's scrolling his feed and he lands on this highly produced video of a finfluencer hyping up the next big thing. In Deepak's case, it was a single electric vehicle or EV startup. The pitch, it was intoxicating. Millions of views, comments flooded with rocket ships, people saying they're all in. Deepak hit a massive wave of FOMO. Now, putting your entire net worth into one unproven startup sounds reckless, right? But to Deepak, it felt brilliant. Why? Because of something called herd mentality. Humans are social creatures. We're hardwired for it. We assume the group knows something we don't. It's an evolutionary reflex. If everyone is buying, it must be good. Deepak saw that digital line out the door and his brain whispered, all these people can't possibly be wrong. It's like the restaurant analogy. If one is empty and the other has a line out the door, you don't even look at the menu. You just join the line. You don't check the health inspection score. You just want whatever they're serving. This collective wisdom is a trap, and it's weaponized by a second trap, the Dunning-Kruger effect. Deepak thought he was playing 4D chess. He thought he saw a shift before all of Wall Street. He felt like he had an informational edge. Spoiler alert, the market is completely indifferent to your personal conviction. Then disaster strikes. Not a slow decline, but an overnight crash. A classic black swan event. The battery supplier for that EV startup issues a global recall. Total disaster. And because Deepak had zero diversification, meaning he owned nothing else, his entire portfolio took the hit. His 2 lakh portfolio absorbed the absolute maximum impact. When the market opened, the stock gapped down 40%. Just like that, 80,000 rupees, poof, gone in a single morning. It's a graveyard of hype out there. If you read the news, it's full of Tesla killers that ended up in Chapter 7 liquidation or bankruptcy. Peak Ample, the battery swapping startup. Hundreds of millions in VC money, big partners, and we still went bust. Or Polestar, great revenue growth, but then boom, a going concern warning. Management basically said, we might not make it. So when Deepak dumped his 2 lakh into one stock, he wasn't investing. He was essentially playing the lottery. But here is where the psychological damage really starts. It's a trap called loss aversion. Neurologically, losing 80,000 rupees hurts twice as much as making 80,000 feels good. This pain causes investors to freeze. They refuse to sell because selling makes the loss real. It's the sunk cost fallacy. You focus on what's already lost instead of looking at what the company is actually worth now. Deepak kept saying, it's just a paper loss until I sell. No, Deepak, it's a loss, period. But hope is a terrible investment strategy. The company never recovered. Lawsuits, supply chain collapse, total wipeout. The emotional toll is the worst part. The shame, the regret, it breeds a sense of, I'm just bad at this. But wait, let's pivot to the alternate path. Let's talk about Kavya and the strategy that saved her. Kavya didn't pick a stock. She chose a Flexi-Cap mutual fund. Now, don't let your eyes glaze over at the word mutual fund. Let's do an explain like I'm 5, ELIF. Kavya isn't buying one car. She's buying a ticket to the whole fleet. She's putting her money into a massive pool. An asset management company takes money from thousands of people like Kavya. So her 2 lakh is combined with everyone else's to create a financial behemoth. And this behemoth is managed by professional fund managers and quantitative analysts. These guys live and breathe data. They operate under SEBI rules, the referee of the Indian markets. SEBI defines companies by market cap. Large caps are the titans, the big banks, the IT giants. They are stable, like big cargo ships. But Kavya chose a Flexi Cap fund, and this is her secret weapon. In a Flexi Cap, the manager has total freedom. They can move money between big, medium, and small companies dynamically. It's like a cargo ship where the captain is forced to keep equal weight on all sides, even if a storm is coming. But a Flexi Cap, the captain can unbolt the cargo and move it all to the safe side instantly. The manager acts as a tactical navigator. If they see a recession coming, they move to safety. Now, here is the kicker. Kavya's fund actually held the exact same crashing EV stock that ruined Deepak. Wait, how? Deepak is broke, but Kavya is chilling? It's all in the math of the structural shield. Deepak went all in, 100% of his net worth in one stock. That's not a strategy, that's a prayer. But in Kavya's mutual fund, that same EV stock was only 1.5% of the total portfolio. So when the battery fire news broke and the stock plummeted 40%, what happened to Kavya? Let's run the numbers. 40% of a 1.5% allocation is a 0.6% reduction in her total value. 0.6%. In the world of finance, that is basically background noise. It's a rounding error on a Tuesday afternoon. While Deepak's world was ending, Kavya barely noticed. And it gets better. Because she was diversified, her other stocks were actually doing the heavy lifting. While startups were struggling with high interest rates, the banking stocks in her portfolio were climbing, meaning her banking gains were literally swallowing her EV losses. This is sector rotation in action. Kavya was playing what researcher Charles Ellis calls the winner's game by simply not losing. Because she didn't feel the visceral trauma of a 40% crash, she never felt the urge to panic sell. She just stayed disciplined. She stayed in the game. And that is the theoretical bedrock of her success. This isn't just luck, it's a Nobel Prize winning concept by Harry Markowitz. Diversification is the only free lunch in finance. Now, you might have heard that high risk equals high reward. We've been taught that since forever, right? But Markowitz and Ray Dalio say, hold my juice. You can actually sever that relationship. You can lower your risk while keeping your returns. It sounds like magic, but it's actually just correlation. Think about it. If you buy Uber and Lyft, that's not diversification. They're basically twins. Same sector, same threats, same oops if the government changes a law. If one sinks, they both sink. The magic happens when you combine things that don't move together. Uncorrelated assets are the holy grail. Forbes did the math. If you have one high growth stock, you're riding a mechanical bull. It's 40% volatility. But if you hold 15 to 20 uncorrelated assets, the risk of a devastating loss drops from 40% to 11%. You end up at the same financial destination, but without the heart palpitations every Tuesday morning. This is why it's called the only free lunch. You get the benefit of safety without paying for it in returns. Before your portfolio turns into another cautionary tale, do us both a favor and hit subscribe. Ring that notification bell so you never miss a breakdown when the next market bubble inevitably pops. Drop a comment below with your biggest investing confession. We promise not to judge much. Share this with that one friend who still thinks crypto is a retirement plan. They desperately need it. Head over to our website linked in the description for full data breakdowns, charts, and reading lists. Stay disciplined, stay diversified, and I'll see you in the next deep dive.